Hi everyone, welcome to Thursday, and of course every Thursday we do a share and review. Today I'm actually going to take a look at Mercury Energy. Now I used Mercury Energy last week in my example of doing a fundamental analysis. So in other words, looking at the balance sheet and evaluating a share based on that. Today I thought let's take a look at Mercury Energy again, and this time put a technical analysis over it and just see how it compares. Because certainly using the fundamental analysis last week, it wasn't a share that could potentially be worth investing in based on the way I was taught. Now, just the disclaimer, obviously this is definitely for educational purposes only, certainly not intended to be personalised financial advice. If you're looking for that, you do need to go and have a chat to your own financial advisor or share broker or the likes. I love doing this, and I actually found that this was a really good example from last week. So that's why I sort of thought, let's go in and review the same share, but use the different methodology. So let's take a look. Right, here's Mercury Energy up on the screen. Now, I am recording this on Monday morning. The market is about to open, and it looks like it's going to open about 16 cents down, or 2.41%. Now, this little green candle we can see at the end here is just for the trading week of last week. Now, it is down, and so often that can happen because, as you can see here, it went ex-dividend, meaning that any shareholders that actually held that share as at the 1st of September, then they would get the dividend on that share. Anyone who bought it on the 2nd of September onwards, you would not get the dividend for this period. And what we quite often see is when a share goes ex-dividend, it is quite common for the shares to fall in value, because there are people out there that will buy into shares just before they go ex-dividend purely to capture that dividend rate. And then the moment they go ex-dividend, so the following day, they will quite often sell out of those shares again. That's their methodology that they're using. They could be using it for cash flow generation, that sort of thing. So that is why quite often it will fall. Now, as an indication, and it's not always set in stone, of course, but usually if you're looking at trading a share, buying into a share, and it is about to go ex-dividend, roughly take a look at that value that the dividend's going to be. And as you can see here, it's about 14.4%. So what you do is you take that figure and times it by 1.5. So you could potentially see a share like this move around potentially 22 cents even. And that's roughly what it's done here. You can see the week before it closed at $6.92. In this example, it's closed a little bit more than that actually. So for last week, it had a close of about $6.49, so just under $6.50. So it was a little bit more than that, but that's really what you should allow, at least 1.5 times the dividend rate, to give that share room to move, especially if you're looking at trading on a longer time frame. In other words, you're not just doing short daily trades or intraday, which could be even weekly. Right, for the first example, let's go and make a comparison as to how this is performing against the main board for the New Zealand Stock Exchange. Here we go here. So underneath we've got the blue line. So that is where the NZX-50 is trading. And as you can see, for this whole 5-year period, Mercury Energy is trading above that. And that's a really good sign. That's certainly something that I look for when I'm buying a share. Let's take that one off. And let's pop on our moving averages. So the first one we will pop on will be the 30. And remember, I like to change that simple to exponential. And great news there, the share is trading above that 30-week exponential moving average. The next one that I want to pop on is also, again, the moving average, but this time we want to change it to a 15-week. And again, we are using exponential. And you can see here that the 15-week moving average has crossed up through the 30-week moving average, and that is a good positive sign. The overall position of the market is that the share is trading above both of those moving averages. Again, that is positive. Let's go and have a quick look on the daily as well. Now, for this share, up until last week, because it went ex-dividend, and that's where you can see, obviously, the share starting to fall. The 12th of September, the share was climbing nicely. It had really nice, strong green candles. However, last week, because it has gone ex-dividend, we've actually only seen one positive day that week, and the market has started to tail off again. The moving averages haven't crossed. So in other words, the 15-week moving average has not yet crossed below that 30-week moving average, but they're certainly facing downwards, and that is something that you do need to take into account. If you've already bought the share and you own it, and I certainly do own this one, I've got my trailing stop in place. So my trailing stop is this ATR figure here, which is 0.17. And I times that by 4 because I want to give my share room to move. So I've got 68 cents. So in other words, this share is currently trading at around $6.49. So my stop price would be probably around that $5.80 mark. So just taking that into account. So it gives that share room to move, gives it room to come back because it's gone ex-dividend, and hopefully then recover. However, if it doesn't, the moment it hits that $5.80, the share will automatically be sold in the market. And what I like about that is it's binary. It means that I do not have any emotion attached to it. I've already done this research before I have bought my buy trade, and it can happen no matter what I'm doing, whether I'm sitting in front of my computer or whether I'm doing something completely unrelated. That's what I like about stop losses. It protects me. And because I've already done my research when the market was closed and I was able to think in a logical manner, it means that I'm comfortable and happy to put the stop where I have. And like I've been saying, it's completely unemotive. And that to me is a really big decision, because otherwise people start to second guess themselves and they will start to say things like, oh, it's a good share. It could go better. It could go higher. It will recover. All of these sorts of things. And they're almost trying to justify why they're not selling out of their share. To me, it's really important to have your rules in place and make that decision before you enter, not whilst you're actually trading. So if I was looking at buying Mercury Energy today, I would actually be saying no. But like I said, I bought it a couple of weeks ago, so I am comfortable in holding it. So not only is it now trading below both of those moving averages on a daily basis, we've also got 2 red candles in a row. Now, that doesn't mean it would be a complete knockout. It would mean that I would not be looking at buying this particular share today, simply because of that. And it's probably because it's gone ex-dividend, and I've mentioned that a few times. The other thing that I would be looking at, so if these were both positive candles and the share was still trading higher, the other thing that I would just take a quick glance at, but it's not completely set in stone, is this RSI. So it's the relative strength indicator. It really indicates whether potentially a share is being overbought or oversold. So it's heading towards that oversold territory. The other reason that I wouldn't be buying into it if I was looking at just the RSI is because on the daily chart it's pointing down. That can be a negative sign. Hey, as you can see, if we look back here earlier this year around March, April, you can see that it really did hit that almost 20 figure, might have been a little bit below. So it can get to oversold, and then it did start recovering. Could happen in this example. I really don't know. Only time will tell. But for me, Mercury Energy, if I didn't own it already, I would certainly be having it on a watch list and just keeping an eye on it on a weekly basis. Now, what I tend to do when I do my own analysis on the share market is I tend to do it over the weekends, simply because the market is closed and it means it's taking out all noise. In other words, I'm not there watching the tickers going regularly on my computer screen. The market's closed, there's no activity happening, so I can sit there and methodically work through my trading list of rules as to whether I want to own this share or not. So what I've just shown you is, for me, Mercury Energy would definitely be on the watch list, but I just wouldn't be buying it this week. So it's not saying it's definitely knocked out, but it's something that I would want to have a look at. The only other thing that I would be wanting to look at as well is down here is the volume. We're not seeing a lot of volume in Mercury Energy. We did have quite a bit of volume back here at the end of February where we did have a big sell-off. But up until then, we're really not seeing a lot of volume. And to me, I do want to see a bit more volume happening in our shares, especially if the share is rising and we've got a lot more green bar charts down here or green indicators down the bottom. It means that the volume is increasing, and it's increasing when people are buying, and that is a very strong indicator as to potentially a share that is in an uptrend. We haven't really got that in Mercury Energy at the moment. But like I say, for me, Mercury Energy is just a wait and see. I own it. So obviously I have got my stop in place to protect me if something should happen. But until that time, I wouldn't be entering any new positions or anything like that, but just taking a look. But what I wanted to demonstrate as well is how the two indicators, so doing technical analysis and purely looking at what the spreadsheet or the charts are showing us, versus a fundamental analysis as to what the balance sheet is showing us, how vastly different they can be. And it's really important, I believe, to predetermine your rules. There's nothing wrong with using a mixture of both if that's what you would like to do. But make sure, I would recommend, is write them down, what your rules are for entering into a share. Could be using a combination of both, and making sure that you just basically methodically tick them off as you go. That will make it a lot more clear cut. It means you're not going to be chopping and changing when you are entering into shares, and you've got a clear direction, you've got a clear path. Because like I've said in previous videos as well, if you keep chopping and changing and using your methodology, you're never going to know which set of rules are going to be working stronger for you if you keep chopping and changing. And that's what it's all about, because most methods will work, but you have to be consistent with them. I really hope that's helped. I feel like I've given a little bit of a lecture on this one. I certainly don't intend to. But if there's a question you've got around share trading, or even if there's a share you would like me to review and pull up on the screen and show and demonstrate exactly what I'm seeing, more than happy to do that. Definitely reach out to me, pop a comment below, and I always come back to everyone's comments when I can, so usually at least once a week. So it's been great bringing these to you, and obviously your input really helps me to create more videos like this one. So until next week, take care.